There is no trading strategy universally considered to be the most profitable. The choice of a trading strategy depends on factors such as investment objectives, risk profile, experience, and personality of each trader. Some of the most common and popular trading strategies include technical analysis, which is based on the study of charts and price patterns to make trading decisions. Fundamental analysis is based on the study of economic and financial factors to predict the behavior of asset prices. Scalping involves making many short-term trades with the objective of obtaining small profits from each of them. There is also swing trading. This approach involves identifying medium-term trends and making trades accordingly. Another well-known one is algorithmic trading. This approach involves the use of software and algorithms to automate trading decisions. But many have asked me about Martingale strategy, which is a casino strategy, but which some traders apply to trade. I am going to explain how the strategy works so that we understand the risk and rewards involved. The Martingale strategy consists in betting again for the total loss at the moment of incurring a loss in a game of chance. In the new bet, the player has the possibility of recovering all his losses, so it might seem that in the long term, the hope of winning with this strategy remains constant and in favor of the player. In fact, statistically, this is the case. The average player's capital, i.e. the money the player has at his disposal to play with, remains constant. The problem lies in the fact that, by incurring successive losses, the player following the Martingale strategy is forced to bet again larger and larger amounts, the accumulated losses, which tend to grow exponentially. After a few betting cycles, the player, whose resources are usually much less than those of the banker, is ruined as he is unable to bet again for the total of his losses. Avoiding players who try to follow the Martingale strategy is anyway one of the reasons why today's casinos set maximum betting limits. Implementing the Martingale strategy in trading can be a risky approach and is not recommended for most traders. However, at your request, here is a basic example of how to implement this strategy. As a first step, we must set a fixed amount of money for each trade. Step 2. We must set a stop-loss limit, that is, a maximum number of consecutive trades that will be allowed before stopping the strategy. As step 3, we must start with a trade with the set fixed amount. Step 4. If the trade is a loss, double the amount of the next trade. And as step 5, continue with step 4 until a profit is made or until the loss limit is reached. Restart the strategy from step 3 with the original fixed amount. In the end, we will be doubling the lost amount until we have a winner and thus have a profit. Let's trade now with this strategy. After taking the trades, we will see if it is profitable and I will give you my opinion about this trading method. As we have seen, the short-term strategy has not worked for me. For the next video on this trading method, we will do it with a lower balance per trade, and I will look for a way to have more effective trades. But I must mention that I do not recommend trading this way, because without a large capital, this method will empty your account very fast, and the emotional effect for your trades or your trading career will be affected. I prefer a strategy that manages a good risk-reward ratio and that is long-term and profitable. I hope you liked this video, and I will see you in the next video, where we will show again how this strategy works.